Welcome back. It has been a brutal week for oil prices, but Wednesday saw some respite as crude recovered slightly from 6-year lows in the previous session. The U.S. oil benchmark West Texas Intermediate gained nearly 0.8% to close around $43 a barrel. Its global counterpart, Brent crude, did even better, rising more than 1.25%. Both are up because global demand has inched a little higher, and that's due to lower gasoline prices. But the International Energy Agency says crude may still feel downward price pressures in 2016. It says the oil production glut will continue through most of next year. Well, some energy companies have slashed jobs to cope with those plummeting oil prices, and now lower demand from China and more supply expected from Iran means there's even more pressure on the industry. Nick Harper has our story.
The oil keeps flowing, but the price keeps on falling. A barrel of oil is now worth more than half what it was last summer. And that's putting huge pressure on US energy companies. Two of the biggest, Chevron and ExxonMobil, were hit hard this earnings season, posting disappointing results well below expectations. But that, it seems, is a sign of the times.
We had kind of an era of scarcity of crude oil, and we may be moving into a longer period where we need to get used to the idea that crude oil might not go back to $90 or $100 per barrel, and you might have to get accustomed to, say, $60 or maybe $70 per barrel over the next 5 to 10 years.
Even those prices seem a distant dream, with barrels currently coming in at the mid-40s. Demand from the world's largest energy consumer, China, also seems to be dwindling. Market volatility and its devalued currency have only pushed prices lower.
China was providing a great deal of demand. They were doing a great deal of buying of the oil. And with the recent chaos in the stock market, there's been more uncertainty about what's going to happen to China.
According to the US Energy Information Administration, oil production has surged more than 80% since 2007. Oil-producing nations are unwilling to reduce their output, despite laying off more than 100,000 workers worldwide. And now there's the added pressure created by Iran. The lifting of sanctions would see unrestricted output, a doubling of production that could further flood the market.
This is sort of like adding fuel to the fire. You already had, even without Iran, you already had supply being pretty prolific, and now you've got Iran, which has capacity to export maybe 2.5, 3 million barrels a day, something in that order.
Of course, this global glut is good news for motorists, with the average US driver expected to save $750 at the pumps this year. And those savings are likely to continue. Nick Harper, CCTV, New York.